Hey guys, it's Mrs. Invest. In today's video, I'm going to be answering your questions that you guys have sent me recently in my email. By the way, my email is in the About section on my YouTube channel. And you guys send me great questions, and I feel that, if someone's gone through the time to find my email and send me an email, it's probably a burning question that a lot of other people have. So I'm going to answer some questions that I think could apply to a lot of people in today's video. Now, all the names and any identifying information has been removed. All these questions are super generic and could have been sent by literally anybody. So never worry if you send me an email that I'm going to publicize it. If it's something super specific about yourself, I would never do that. So these are just general questions, and I hope you can learn something. And also let me know if you like this Q&A style video, because I could definitely do more of them. I get a lot of emails, yeah, I just want to do whatever you guys would like to see. So I'm trying this kind of video format out. So let's get into Q&A of questions you guys have sent me. Question number 1. I really enjoy your videos and thank you for sharing your knowledge about investing with us. Oh, thanks. I saw your video about CDRs last night, and I was just wondering if I need to fill out the W-8 Ben form if I hold CDRs of Apple, Amazon, and Tesla in my taxable account. Your input would be greatly appreciated. This is a great question. So CDRs, I have made a video on this, are Canadian depository receipts, and basically you buy and sell them through your brokerage account the same way you would US stock, Canadian stock, ETFs, but it allows you to buy fractional shares of US stock in Canadian dollars, so you don't have to go through the US conversion fees. You pay a small little bit for the benefit of having the CDR, but if you don't buy a lot of US stock, it's a lot less hassle than having to convert to US currency, open a US dollar account, etc. Now, normally if you held shares of Apple, Amazon, Tesla in your taxable account, you would get paid dividends. Well, not with Tesla because it doesn't have a dividend, but with Apple for sure. And because it's a US company, the dividends are not treated the same as Canadian dividends. So there is something called a withholding tax that you have to pay on the dividend. So let's say you get paid a dividend of $10, a little bit gets taken off of that for tax purposes to the US government. Now, normally the tax rate for a foreign dividend would be 30%. So if you got paid $10 in foreign dividend, you would have a $3 tax. But because Canada and the US have a tax treaty, if you fill out this form called W8-BEN, W8 Ben, it reduces the taxable, it reduces the withholding tax from 30% to 15%. So the answer to this question is yes. So although you are buying the US stock in a roundabout way through the CDRs, you are still essentially, the underlying holdings are US, and so you would be subject to the withholding tax of 30% unless you filled out a W8 Ben form. Fill out the W8 Ben form if you are intending on holding any shares of US stock, whether directly in US dollars or indirectly in Canadian dollars or through ETFs. And if you are with CIBC, I'll link below the link where you get the W8 Ben form. If you are with another brokerage, just go on their website and look up W8 Ben form, and usually it's linked right there, so you can download it, fill it out, send it to your brokerage, and yeah, then you're done. Okay, question number 2. I have a question for you that seems to be a gray area, and I was hoping your expertise could help. Well, thank you, but I wouldn't classify it as expertise. I would classify myself as a totally regular person who's just oddly a little bit too interested in this stuff, and yeah, anyways, thanks. My question is, I've maxed out my TFSA contribution room and receive monthly dividends of about $500. Although I'm maxed out, can I reinvest those dividends into my TFSA without paying the 1% penalty, or do I have to wait until the new year, January 1st, 2023 to reinvest? My heart is so happy. You maxed out your TFSA. You were getting dividends in your TFSA. $500 a month. That is incredible. Wow, you're doing a great job. And you want to reinvest those dividends in your TFSA instead of taking those dividends and going to Taco Bell. I am just so impressed here. This is fantastic. But this is also a really great question. So everybody pretty much knows that every year you have a certain contribution room in your TFSA. For the last couple years, it's been around $6,000. That means you can take $6,000 from your checking account on January 1st each year, provided you're not over contributed or anything, but just generally speaking, you can take $6,000 and put that money into your TFSA. So money coming from outside the TFSA to inside the TFSA. That's your contribution limit. What she's trying to get at here is money that is generated within the TFSA. So whether that's you get dividends from stocks within your TFSA, so you're getting a cash buildup from those dividends, or let's say you bought a stock and sold a stock in your TFSA and you have a cash gain. Does that count towards your contribution room? No, it doesn't. So any money that's generated within your TFSA, you can right away reinvest that money and it does not count against your contribution room. And this is where the TFSA really starts to get incredible, because you get to a point where your yearly cash buildup, whether it's through, for a lot of people, it's Canadian dividends or sometimes capital gains, starts to become greater than your contribution room. So, let's say every year you're making $10,000 in combination of dividends and capital gains, you can still contribute $6,000 in January, regardless of how much you have made within the TFSA. There's no limits as far as what you can recontribute, or sorry, I shouldn't use that word, what you can reinvest from money that you've generated within the TFSA. And I think I'll try to find the page, but I think there's like a couple people that Canada CRA keeps an eye on, because they have like $2 million in their TFSA because they YOLO'd it to something ridiculous and it ballooned, and they've sold it within the TFSA. So they have like insanely high TFSAs, but there's a couple, I think, people in Canada who have like ridiculous balances in their TFSA. And those people, if they have 2 million from YOLOing into a meme stock, I mean, good for you, it's very risky, but it's going to happen to somebody. Somebody's going to end up winning, right? Those people can still contribute $6,000 in January. So your contribution room and reinvesting what's growing within your TFSA are two completely different things. They're not affected, which is really, really nice. Okay, question number 3. I'm trying to dollar cost average through CIBC Investor's Edge. It seems expensive, is it? And there was a lot more to this email, but I cut it out because I didn't want to identify the person. But basically what they were getting at was they wanted to invest monthly into ETFs. Every time you get your paycheck, you want to invest a little bit per month. But of course, if you're investing monthly, you're only going to be buying a little bit of shares. And so they were saying, $7 for commission every month if I'm only putting in maybe $100 or $200. It seems like a lot. Is that right? And is there a way around it? And unfortunately, yes. Every time you place a trade, whether you buy 1 share or 1 million shares on Investor's Edge, you're going to have to pay the commission. So the smaller amount of shares that you're purchasing at a time, the greater percentage that commission fee will be as part of your total. It'll eat into your total what you're investing. So there's a couple things to weigh around this. One is if you're just buying ETFs, as this person said they were going to, Questrade is a good option because you have free ETF purchases. So you can purchase ETFs monthly. Now, when you go to sell, you do have to pay the commission, but if you're buying an ETF, you're probably purchasing it for the long term. So, if you're investing monthly and you want to save that $7, or let's say you're at another brokerage, most of them are almost $10, $9.95 or whatever. It'll save you $10 a month, which let's say you're only investing $100 a month, then that's like 10% of your total investment. So, it adds up over time. But if you want to keep everything kind of in one place and you don't want the hassle of having different brokerages, then another option is to sort of lump sum invest. So that's kind of what I do. I generally don't invest monthly. I kind of hoard cash for a little bit and then deposit a lot at once. And so that kind of reduces the number of times throughout the year that you'll have to pay that commission. But yeah, those are kind of the only two ways I can see getting around paying that. This next question is a really good one, and it's kind of a general topic of what to look for when you're buying shares of stock. But this person's specific question is, I have a question for you. I bought shares of Bank of Nova Scotia BNS on the Toronto Stock Exchange, and I want to know what are important indicators to check or look for from time to time, and where to access accurate, updated information on these indicators in order to buy BNS shares. So let's talk about Bank of Nova Scotia. specifically first, and then I'll talk about just like generally things to look for regardless of what type of stock you're holding. So for Bank of Nova Scotia, what we know is it's a very established company. It's not growing very much. It's a Canadian bank, which is a really core business to the Canadian economy. You know, if the Canadian banks fail, we are totally screwed. So you kind of go into it with that lens. You know you're not going to be getting crazy growth in a short period of time. You're basically buying in for as much stability as you can get in the stock market. When the market goes down, BNS will go down with it. But in terms of, losing your entire investment, it would be pretty shocking to see Bank of Nova Scotia, go to zero, or any other Canadian bank. A lot of people buy the Canadian banks, myself included, for the dividends. BNS was actually the first stock I ever bought. So when you're thinking about a really established company, the things that you're looking for are basically consistency quarter to quarter and year over year, and that they're delivering on earnings per share. You aren't really looking for crazy earnings growth. You want earnings to be growing year to year because of, inflation and everything else, but you're not looking for insane growth from year to year. You're looking that they're just continually delivering and continually meeting analysts' expectations. With a really stable company like this, analyst estimates for each quarter in terms of what their earnings per share will be are going to be pretty accurate because the company has such a long track record. There's not many surprises. And the thing you really want to look at if you really want to get into it would be the quarterly reports. So every quarter, every company announces when they're going to be making their quarterly report, and you want to go on to Bank of Nova Scotia Investor Relations, and they will have everything there: quarterly reports, annual reports, and just see, are earnings growing? Is earnings per share what the company or what the analysts expected earnings per share to be? What's the general trend over the last few years? And that will give you a really good idea. But honestly, a stock like a Canadian bank is pretty, I honestly don't even look at the quarterly reports. I just sit back and collect the dividends. It's a pretty, let's say, boring stock. If you're thinking about, just more growth-oriented stocks, what to look for, that's when it's more important to focus on the quarterly report, because often they're younger companies, they have debt. You want to make sure that the earnings are increasing, relative to service the debt. You want to make sure the profit is there. So really breaking down the quarterly report more than you would for a stable company like a Canadian bank. And for a growth stock, you want to make sure the growth is there, the growth in the earnings. The company said we're going to be growing 20% this year. Did they? A recent example would be Lucid stock, which is they're probably going to go bankrupt, I think anyway. They said last year we're going to make 15,000 cars this year. Now they've just revised it recently to say we're going to make 6,500. I don't even think they're going to make 6,500 this year. So those are kind of things you look for. It's okay, the management is cutting their expectations. That's not good. Those are the kind of things you want to keep up on. And this is one reason why I have very few stocks in my portfolio is it takes a lot to keep up with a company truly. If you have 30, 40 stocks, this is way more than a full-time job to keep up with all these companies. I guess this is why ETFs have become super popular, because it's a lot less micromanaging of looking through the nitty-gritty of each quarterly report, and it's kind of just a melting pot of buy and hold. But yeah, I hope that answers your question. Okay, let's get into some Tesla stock specific questions, because I have shared that I have a good percentage of my portfolio in Tesla stock, so I do get a fair amount of emails on this stock in particular. So let's just kind of hit some of those now. Now this email, just for reference, I believe the person sent it to me on May 20 something, and I responded back on May 23rd of this year. So that gives you an idea of timing of where the stock price was. And at that time, let me just check, the stock was, in hindsight, it was actually close to the low. It was trading at $224 post this most recent split, and now we're at about 303. So it was actually quite close to the bottom actually, but of course you don't know that at the time. So they sent me a couple questions. They're all good ones, so let's go through them. Question one was, of your 2030 stock price predictions in the video I have on my channel, 10K, 7.5K, 5K. Now, of course, those were pre-split, so you have to divide those all by 3. Which one do you really feel the strongest about? And my answer was that I feel the most strong about $10,000 per share by 2030, which is post-split is 3333.333 per share by 2030. And I basically said it depends on AI progress, so the robotaxi and the Tesla bot, and I think if everything goes wrong, basically all they keep doing is making cars and not making them at the rate they say they're going to, so just some more stunted growth compared to what they say. I would estimate about 5,000 by 2030, and then that would be 5,000 divided by 3. Question 2, do you think the current price of 664, which is 221, do you think the current price of $221 of the current split is a good time to get in? Almost a rhetorical question given your analysis in the video. Yeah, I wonder what I'm going to say. I want to get your true feelings about Tesla's recent sell-off. And my answer was, this is the bargain of the century for Tesla stock. I wish I had more cash to buy more shares right now. Tesla, the company, is executing at an insane level. This is true. And yet the stock is down 40%, which was also true at the time. And that was actually around the bottom. It went down to about 40%, and now we're kind of on the up and up. This is one of those rare times where the stock price doesn't reflect the quality of the business and is an excellent buying opportunity. This is true. When you see a company executing, growing at an insane level, doing things that other companies are literally flopping at and realizing is insanely hard to do, as I just talked about with Lucid having to cut their production estimates because they're realizing it's really damn hard to make EVs at scale, and the stock price is down 40%, that is a mismatch in the market, and that's a great time to get in, and you have to hope and assume that the market is eventually going to figure out what is happening, because sometimes the market is wrong, and good companies fall due to outside factors like all this craziness that's happened this year with the interest rates and everything else. And I said, I think we'll look back at today and wonder why we didn't put every cent into the stock when it was in the 600s, which would be the 200s. And today we're at 303. And I think Q3 and Q4 are going to be insane for Tesla. I don't know what the stock market will recognize, but at some point it has to. They can't keep going. Otherwise the PE is going to be like negative. It'll be a joke. So at some point it will happen. But until then, I just have to wait. Question 3. Related to that, but given Tesla's massive sell-off, where do you think the bottom is? Well, it's kind of ironic. The bottom is right when you're emailing me. I said nobody knows. Past corrections of the stock have bottomed at around 50%. Example, March 2020 went from 950 to 400. So somewhere around 50%, I'd say, but that's an honest guess. And I believe the bottom was around 45% this time. So Tesla has a nice habit of dropping around 50%, which is really great for us. It's really good for your blood pressure and your cardiovascular system and your mental health and everything else. Okay. Last question from this person. Do you think that your arguments expressed in the video, he's referring to my video of my 2 videos I've made on Tesla stock. You can watch them. They're a bit farther back in the channel. Do you think those arguments expressed in the video of Tesla being overvalued are just as valid today, a year after you made them, or would you revise them? So in that video, I was talking about how people say Tesla stock is overvalued. It was about a year ago, and how I was saying they are wrong and how the stock is actually undervalued. This was at a time when the PE was really high and people were freaking out, and I was just saying, like, you guys, everybody's wrong, it's not overvalued. So my answer was, Tesla is more undervalued today than it was when I made the video because it's trading at almost the same price, which is true. When I made the video, I put it in the comments of what I thought what the price was of the stock. It was like 600, and then when I made this video, it was also trading 600 something before the split. So it was the same price 1 year later, despite massive execution on the part of the company. So, doesn't make sense to me. I think it's more undervalued today than when I made the video because it's trading at almost the same price, but the company has progressed significantly since then. The future is bright. The stock price just doesn't reflect it right now. Unfortunately, this is important. Unfortunately, many people use the stock price as a gauge of how the business is doing, and in the short term, like right now, it can be very wrong. This is true. The stock price long term will 100% reflect the business. In the short term, it may not. And if you can capitalize on those opportunities where a stock is depressed, but the company's executing to an insane level, you will make a lot of money in the long term, I truly believe. Great questions, thank you. Next question. What is the most cost-effective way to buy a small amount of US stock as a Canadian? I don't have any plans to buy any other US stocks in the near future. I haven't chosen a brokerage yet, and I plan to put all my investments in my TFSA. Well, this is awesome. Sounds like you're just getting started investing, so congratulations. If you're buying a super small amount of US stock, The best way and probably least hassle way would be through CDRs. I talked about it in this video earlier, and I have another whole separate video on CDRs. That way you don't have to open a US dollar trading account, you don't have to convert currency, which may be worth it if you're only buying, you know, a little bit once every few years. You're just not into investing in foreign countries. So that's one way. The other way would be to open a US dollar trading account, sign the W8 Ben form, learn how to do Norbert's Gambit so you don't get hosed on currency conversion, transfer CAD to USD in your US dollar trading account, buy the shares in US dollars. Yeah, that would be the other way. So CDRs or US dollar trading account, or let's see. So she wants to buy US stocks. So if you want to buy US stock, those would be the only ways. But if you want to buy US stock through ETFs, then you could buy an ETF like VFV, VUN, ETFs that hold US stock within them, but you buy in Canadian dollars. But that's only an option for ETFs. You can't do that with individual stocks. Okay, last question. I was wondering if you have a program or one-on-one course option available. Thank you for your time and amazing work on YouTube. Well, thank you so much. The answer is no. I have not sold anything to anybody, and I have not taken a penny other than the small pittance I make from ad revenue on this channel. I have no links under my videos. I've never been reached out to by a company that I think is worthwhile enough to share with my subscribers. I don't do this for the money. I do it because I enjoy it. I'm not saying I will never do a sponsorship in the future, but if I do, it better be a damn good one, because I'm not shilling garbage. I have thought about you know, doing one-on-one stuff. I have gotten quite a few emails, you know, like this about doing one-on-one discussion, I guess let's call it. But I have some issues with it, and I would love to hear your guys' thoughts about it. On one hand, I would love to like meet with people live who watch my videos and just chat about, you know, investing. I think that would be amazing. On the other hand, I get the sense that the people who've emailed me so far, they want, you know, like personalized financial advice, like what should I do given my situation? And unfortunately, I think that gets into an area where it's like you have to be like a licensed financial advisor to give people personalized financial advice. I really don't feel that I'm qualified to do that. I just can't figure out a way to do it that doesn't lead me down a road where I'm giving people personalized advice. Let me know your thoughts. I would really like to know your thoughts on that, because I'm really confused about what to do there. But anyways, that's it for the Q&A today, guys. You can email me any questions you have. I check my email once in a while, but I do get back to almost everybody. And my email's in my About section. You can also follow me on Twitter at MrsInvest1. And let me know if you like this style of video and if you'd like more Q&As, because I can certainly do them. This was actually really fun and a different style of video. I enjoyed it. All right, I'll see you in the next video. Bye.